Have you ever been denied a loan or stuck with sky-high interest rates? Your credit score could be the culprit. Today we'll break down everything you need to know about credit scores and how to improve yours. Stick around because our last tip could be the key to unlocking financial opportunities. Welcome back to Financial Blueprints. If you're new here, we're all about helping you take control of your finances. Today we're diving into credit scores, what they are, why they matter, and how you can boost yours. Stay with us until the end for a crucial strategy that can make all the difference. First, let's talk about what a credit score is. In simple terms, your credit score is a number that represents your creditworthiness. It's used by lenders to decide whether to approve your loan applications and what interest rates to offer. Credit scores typically range from 300 to 850. The higher your score, the more favorable terms you'll receive from lenders. So, why do credit scores matter? Your credit score affects your ability to get loans, credit cards, and even housing. A higher score can result in lower interest rates and more favorable loan terms, potentially saving you thousands of dollars in the long run. A lower credit score, on the other hand, can lead to loan denials and higher interest rates, making it more expensive to borrow money. Now, let's break down the factors that influence your credit score. There are 5 main components: payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%. Payment history is the most important factor. Make sure to pay all your bills on time. Each time, late or missed payments can significantly lower your score. Set up automatic payments or reminders to help you stay on track. Next is the outstanding amount you owe. Keep your credit card balances low and try to pay off your debt rather than just moving it around. Your credit utilization ratio, the amount of credit you're using compared to your credit limit, should ideally be below 30%. Reducing your balances can boost your score and show lenders that you're responsible with credit. The length of your credit history also matters. The longer you've had credit accounts open, the better. Don't close old accounts, even if you're not using them regularly. Keep those old accounts open to maintain a longer credit history and a higher score. Be cautious with new credit. Applying for several new credit accounts in a short period can lower your score. Each application triggers a hard inquiry, which can impact your score. Space out your credit applications and only apply for new credit when necessary. Lastly, your credit mix, the variety of credit types you have, like credit cards, loans, and mortgages. Having a diverse mix can positively impact your score, but it's not as crucial as the other factors. Don't open new accounts just to diversify your mix, but if you have different types of credit, it can help your score. And now, for our crucial strategy, regularly check your credit report. You're entitled to a free report from each of the major credit bureaus every year. Review your reports for errors or fraudulent activity and dispute any inaccuracies you find. Keeping your report accurate is essential for maintaining a good score. So there you have it, a comprehensive guide to understanding and improving your credit score. By focusing on payment history, managing amounts owed, maintaining a long credit history, being cautious with new credit, and understanding your credit mix, you can boost your score and open the door to better financial opportunities. If you haven't seen our previous videos on debt management, building an emergency fund, and saving money effectively, be sure to check them out for more foundational tips. And stay tuned for our next video on credit cards. Understanding their benefits and risks is crucial for your financial health. If you found this video helpful, please subscribe to Financial Blueprints, give this video a like, and share it with your friends. Until next time, take care and stay smart with your money.